And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? Hope you're doing well. And whether you just happen to drop by and you randomly found this radio show or this podcast, if you're watching on johnsonwim.com or maybe even our YouTube channel, The Capitalized Retirement, I just want to say welcome to the program. Today we're going to be discussing the opposite of prepared. Now that might sound just a little bit funny, but when we think about last week's events, when we think about what happened over the weekend, I think that this is a very important point to cover. I think it's something that we need to be thinking more about. When you heard the news, when the news broke about the surprise attack and us bombing Iran, I'm curious, what were the feelings? What were the thoughts that were running through your mind? You know, when we think about the opposite of prepared, synonyms come to your mind like unprepared, caught off guard, surprised, unready. All of these things are so very common to human nature. And I want to say that no matter how much you and I might want to be prepared for everything, no matter how much we strive to be prepared for the unexpected, we're still going to get caught off guard, aren't we? We're human beings. There's no way that we can prepare for everything. We can have a home that is more structurally sound against the wind, but that doesn't mean that our home can't be destroyed by an accidental fire. We can be prepared by having all of our money in the bank, and we can make certain that that money is safe in the bank. And yet we could have things like a foreclosure on a bank. We could have unexpected rise in inflation, and all of a sudden now we're losing money on our money because of inflation. No matter what you think, no matter what scenario you can contrive, the reality is that all of us are unprepared in some way, shape, or form. But when you think back to that moment that you saw the headline, that you heard that piece of news that we had sent bombers into Iran and we had bombed them, what was your first reaction? Did you have a sense of panic? Did you have a sense of worry? Were you concerned? Here's a question for you. Did you think about your money? Did you think about the stock market and how the stock market might react to this news? After all, this was really groundbreaking, earth-shattering news. No one, I think, saw this coming. Yeah, we might have seen little hints here and there that things were ramping up as far as the threats from our country to their country, trying to get them to be motivated to go to the negotiation table and actually have some negotiation with Israel. But did any of us really realize that it was going to be taken this far, that there would be affirmative action being taken? I know I certainly didn't think about that. I really didn't think that it would come to this, and maybe you didn't either. But the point of today's radio show is, are you really the opposite of prepared? Especially when it comes to your money, especially when it comes to your retirement, especially when it comes to all of the liabilities, the things that can potentially affect us in a very negative way when it comes to retirement. You see, if we've never really thought about it, when you're in retirement, when you've lost the security of that paycheck, you are really at your most vulnerable stage. I've often given the example when we think about when we think about Mount Everest, and we think about the one person that primarily comes to our mind as the first person to summit Mount Everest. It was Sir Edmund Hillary. And why do we think about Sir Edmund Hillary? Well, the reason that he comes to our mind is because not only did he make it all the way to the top of the mountain, He actually made it all the way back down the mountain, and he lived to tell the tale. From a statistical standpoint, and I'm no mountain climber, but statistics show us that when it comes to climbing mountains, it's not as dangerous climbing the mountain as it is descending the mountain. And in many respects, when it comes to saving money, when it comes to accumulating our wealth and compounding and growing the amount of retirement savings that we have to work with by the time we actually make it to retirement, it's actually a lot simpler than the distribution stage of life, where now all of a sudden we have to make this money last essentially the rest of our living lifetime. It's very difficult to navigate that. There's so many different variables and things that are well beyond our area of control. And so I want to have you just consider, how did you feel when you saw that news was breaking? Did you go online and check your balances? Did you happen to send an email to your financial advisor? Did you have a discussion with your spouse and air your concerns as to what was going to happen on Monday morning when the markets opened? These are all human nature things. These are all things that we think about, that we dwell upon. Some of you might have lost even some sleep over all of this, thinking the very worst, that we would be going to war, which is always within the realm of possibility. Well, the reality is that is normal. But the time to prepare for instances like this is not during moments like these. It's not during or even after moments like these. In fact, if I was to go back and rehearse all of the various moments in time, which kind of sticks in my mind as the advisor as some of the scariest moments. The tech bubble burst, the dot-com bubble where the S&P 500 lost 50%, the Great Recession of 2007, 8, and 9, where banks were failing and the stock market significantly lost. And it wasn't just, a short-term thing. It wasn't just a few days or even a few weeks or even a few months. But folks, the dot-com bubble lasted, when that bubble broke, that loss, that attrition from the stock market lasted 3 years. The Great Recession of 2007, 8, and 9 lasted 2.5 years. No one will argue that the market comes back. The market always comes back. The big question is, how long is it going to take and what damage is going to be done in the interim of time? And maybe you were thinking that. Maybe your mind was contemplating all of the potential outcomes of what took place, what you were seeing on the news. But again, the time to prepare is not during one of these moments. It's not after one of these moments. Now, granted, if you're getting prepared after the moment, that's great. That means that whatever you've gone through as an experience has taught you to be better prepared for the next time if it does happen again. But I want to talk about your responsibility, and I want to talk about my responsibility. You see, today, most financial advisors have been conditioned. They've been taught to just basically reassure the client that everything's going to be okay, even if the financial advisor doesn't really even believe it. And I know that sounds absolutely terrible. And you know what? It really is terrible, because financial advisors are human beings too. We feel panic. We feel stress. We feel anxiety. We feel worry. In fact, I would dare say the financial advisors feel it in a much more compounded way, because think about the job that we have as a financial advisor. Our responsibility is to our clients. Our responsibility is to make certain that our client is well taken care of. And yet so many of the business models today, so many of the institutions that advisors work for, handcuff that financial advisor. They in some way, they prevent the financial advisor from doing everything that the advisor could be doing as an advisor to make certain that that client is safe. And I know that that sounds very odd, but I want you to just think about for a moment. What if you're the advisor that's handling a 401k? That 401k from that employer that you might work for is going to want to keep that 401k simple. Remember, the 401k is here to serve the general masses. The 401k is here to be something that's simple, that people can check mark a box, they can invest in some way, shape, or form, and problem solved. The employer has provided the ability for the employee to save for retirement. That's a value add for that employer. That's a value add for the employee. But when that employee is looking for something maybe unique, something special, something that's going to really be more catered to them and to their risk tolerance and what they're trying to accomplish, well, that financial advisor handling that 401k has to be extremely plain and extremely clear with that employee that I'm sorry, you only get this list of investments to invest in. When you're a financial advisor and you work for a particular franchise, a particular institution, you're in a position where if that institution does not sell what you believe is in the best interest of your client, well, guess what? You're kind of out of luck as the advisor. And many of you listening to this radio show did not realize that. This is the reason why so many fiduciaries today are independent, because they want to be able to provide the universe of alternatives to their clients. They want to be unfettered by that goal of the bottom line that many institutions are in the business for. Don't get me wrong. Many of the large institutions are here to help people, and they do in many respects. But it's also a business, and that business is designed to make them money. Otherwise, why be in the business? So getting back to this past weekend's events, how did you feel? And did you experience a sense of unpreparedness? If you did, I encourage you to sit tight. We're coming up to our first break. After we come back from the break, we're going to be discussing the things that you may want to now prioritize so that you're not caught off guard the next time something like this happens. Sit tight. We'll be right back. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, if you're just joining us, welcome to today's program. Today we're discussing the opposite of being prepared. So many of us heard the breaking news that we had attacked Iran, sending bombers in, destroying what likely was and probably has been a working nuclear facility. And when that news broke, my question to you was, how did you react? How did you feel? Did you have a sense of unpreparedness? Did you panic a little? Did you worry or lose sleep? For literally millions of Americans across the United States, when that surprise news hit the news headlines, it was surprising to many of us. And the reality is that the time to be prepared is well before the event. And what is the event? What is the it that we should be prepared for? Well, it could be anything. And obviously in the first half we discussed, as human beings, it's absolutely impossible to be prepared for everything. We just simply aren't that we're not built that way. We can't do that. But when it comes to your money, I believe that there is so many ways in which you can better prepare yourself for moments like these. It could be anything. It could be a loss of a job. It could be a spike in inflation. It could be an accident that you didn't expect to happen. That's why it's called an accident. You could have a loss of a loved one. You could have a massive expense that you didn't expect. I recently had a client that they were getting ready to sell their home. And of course, part of selling the home and part of buying the new home is the fact that there is a home inspection. And when this couple who had lived in this home for years and years had that inspection, little did they realize that a large majority of their home had black mold growing in it. You know, it could be literally anything. But I want to go back to something that was said earlier. When you work with a financial advisor, this is the reason why you work with a financial advisor. I want you to think very carefully about the business model that your financial advisor has. Now, for those of you that are longtime listeners, you know that the vast majority of the financial services industry is focused on one thing, and it's growth, accumulation, capital gains. And you know what? We all need the growth. We all want the growth. This is something that's so very important and vital to us because, you know, you can live a lot better of a lifestyle on $1 million than you can on 100,000. This is the reason why we put our money at risk, why we invest in the market when we're younger and we have the security of the paycheck. This is the reason why when the market is down that we increase how much we're deferring into buying more investments. Because after all, we have the security of the paycheck. But as we get closer and closer to retirement, we are now closer and closer to the most vulnerable stage of our life, the distribution stage. And this is where, when a mistake is made, that mistake could cost you a very hefty price. Irreparable damage can occur if the wrong decision is made during the distribution stage of your life. So my question is, are you working with an advisor? Are you working with an institution that actually has addressed all of the various different financial things, the financial risks that can occur to you if bad things happen? It could be inflation. It could be the accident. It could be the loss of a job. I have a client that just last week, he was planning on working until he was 70. He's 68. And he walked in Monday morning, and the plant manager let him know that his position had been eliminated. Himself and all the other people in his division now found themselves without a job. He wasn't planning to retire just yet. And yet, now he's lost the security of the paycheck, and he's trying to figure out what he's going to do. Is he actually going to be able to be okay being without a paycheck 2 years sooner than he expected? You see, this is the reason why you work with an advisor. And if your advisor is not addressing these concerns, these things that we all know lurk in the shadows, all of the things that can literally devastate a retirement, whether it's a death or a long-term care facility stay, then I want you to be questioning whether or not you're with the right firm. You see, as an advisor and a fiduciary, I've given the example that when you drive your car, you're driving your car and the distance to your horizon is about 20 miles. That's about how far the average human being can see. And yet the advisor is to be flying in that plane that's at 30,000 feet. That advisor can see 200 miles, a lot further than you can. And the worst possible thing that you can hear when something goes terribly wrong in the market or geopolitically or economically is, well, I'm sorry, but I don't know how we're going to recover from that. Well, I'm sorry, but you don't want to sell now. You just want to wait for it to recover. Remember, the markets always recover. Well, this time it's going to be different. And I know that many of you have heard those things. You've heard those phrases. You see, if we think about really the primary reason why we've worked so hard to save this money, it wasn't necessarily because when you got to retirement, you wanted to pull a big chunk of money out, a big lump sum amount, and go build a new home. Most people don't put money into a 401k that's taxable and then pull all that money back out to build that new home. They're crazy because, well, after all, they would end up getting absolutely just ripped by taxes. Most people don't set money aside prior to retirement just so that when they get to retirement, they can live on next to nothing and leave everything for the kids. Most people don't do that. Now, you could be the exception. But most people save this money because they know when they get to retirement, they're going to need that money in order to be able to supplement their retirement, in order to be able to maintain that standard of living that they have grown accustomed to. And in fact, many of you have goals, you have dreams, you have aspirations, you have trips that you want to take, you have things that you want to do. And it's going to take money outside of Social Security, money outside of a pension, income outside of rental income that's going to be necessary for you to accomplish those dreams and those aspirations. You see, anybody can chase a double-digit rate of return on the market. Anybody can do that. Any person can put their money on red number 7 and spin that roulette table, that wheel. But the reality is do you really want to do that? You've taken all of these risks, all of these years during your working career, saving this money. Today, you've got more money than you've ever had, save for retirement. And you know what? Taking risks has been worth it for you. It's allowed you to grow and compound your money faster than the money sitting in the bank. Much faster than putting the money in a jar and burying it in the backyard. No doubt. But do you want to continue to risk that money now that you're in retirement? You see, when things happen, unfortunately, things happen very, very quickly. This is like the diabetic that gets the diagnosis of diabetes, and then they begin to eat healthy. Then they begin to exercise. Now, I'm not putting down diabetics. Trust me, my family is full of diabetics. But I've watched this over and over again, and you and I are human beings. We tend to not do the right thing until after a big event has occurred. May I suggest that the time to plan for inflation is now. The time to plan for more income is now. The time to plan for a potential market-rocking event is now. And that does not even mean that you have to be out of the stock market. It just means that you need to better diversify. It means that you need to potentially more prioritize now income being produced by what you've worked hard to save, rather than continuing to play chicken with the stock market. You see, life gives us so many opportunities to be able to do a course correction. And I got to say, some of us are hard learners. Some of us are perpetual optimists. We say, oh, it'll be okay. It'll come back. But if you're not actually in retirement, if you're not actually drawing income off from your portfolio, I might submit and ask you to consider the fact that it's much easier when you don't need the money to say those things than it is once you're retired, once you're on that quote-unquote fixed income. And then that big it comes along, whether it's an unexpected expense, a death of a loved one, an accident, having to go into a long-term care facility. The time is now to prepare for those things. And this is the importance of having a financial advisor. This is the importance of having a fiduciary. This is the importance of being open and honest about your fears and your worries and your concerns with that advisor, and making doubly sure that the skill set of the advisor that you work with, not only does he hear what you're saying or she hears what you're saying, but they have the tools to address, they have the skill set to address, they have the intellect to bring to you the potential liability and the risk before you even think about it, so that they're taking good care of you to prepare you for this. Doesn't that sound like a much more appropriate course of action? So hopefully today you give some thought and some consideration to how you felt when the news broke. And now I want you to think about your money. Are you as prepared as you should be? Have you thought about the liability of just simply living too long or living longer than you anticipated? It could be something as boring and benign as that could potentially risk and pose a risk to you and to your retirement and to your lifestyle. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.